Welcome back to the Daily Crypto Deep Dive. Today, we're going somewhere few people dare to go. Behind the screens, the coins, and the charts, there's a world that even most traders never see. A world where power is traded in whispers, alliances are formed in private servers, and fortunes are made or destroyed in seconds, all without a single headline breaking the news. This is the story of crypto's most dangerous secret societies. If you've ever wondered how certain coins suddenly explode out of nowhere, or why the market sometimes moves hours before news breaks, this is the answer. It's not luck, it's coordination. Quiet, calculated, ruthless. Before we get deep into it, make sure you're following the show and drop us a 5-star rating if you haven't already. It helps new listeners find us, and it keeps us digging into the parts of the crypto world others don't touch. In the early days of Bitcoin, the closest thing to a secret society was a handful of cypherpunks and cryptographers on internet forums. They debated privacy, math, and philosophy. They weren't in it for money. They were in it for freedom. But as Bitcoin's price rose, something changed. By the time it hit $10,000, crypto had become a new kind of battlefield. And wherever there's power, there's organization. The first whisper networks began to form around 2013. Back then, they called themselves signal groups, or pump rooms. Telegram was the weapon of choice, encrypted, disposable, and fast. You'd get an invite from a friend, you'd join a chat with a few hundred others, and then one admin, always anonymous, would drop a single message. Next coin, Verge. Drop incoming. The plan was simple. Everyone in the room bought in, the price spiked, and the admin sold before the rest even realized what had happened. They called it coordinated liquidity. Regulators called it manipulation. But this was the Wild West, and for most of these early groups, the profits were too good to walk away from. Fast forward a few years, and those crude pump and dumps evolved into something much more sophisticated. Some of the biggest whales realized they didn't need to rely on chaos. They could create order. And they could do it behind closed doors. Today, these networks exist in layers. At the outer edges, you'll find the casual Telegram alpha channels, where influencers share early access to token launches, airdrops, or supposed insider intel. But deep inside, there are private rings, invitation-only servers with less than 100 members, where traders, developers, and even exchange insiders coordinate billions in liquidity. Now let's go deeper, into the world of DAO cartels. When decentralized autonomous organizations first launched, they were supposed to be the antidote to corruption. A way for the community to govern without backroom deals. But what happens when the backroom just moves on-chain? In 2022, analysts at Delphi Digital uncovered something remarkable. A handful of wallets voting on major DeFi proposals weren't individuals at all. They were clusters controlled by the same few funds. These wallets would split their governance tokens across multiple addresses and then vote in unison to push through changes that benefited their holdings, sometimes unlocking millions in liquidity. This isn't illegal. It's democracy, tokenized. But when a small circle can control a billion-dollar protocol's direction, you start to wonder whether decentralization is really that decentralized. Inside private DAO channels, coordination is everything. Some even use pseudonymous voting rings, where DAO members share early drafts of proposals before they go public, allowing insiders to position themselves long before anyone else even knows a vote is coming. The result? A handful of whales quietly shape the evolution of decentralized finance, while the community cheers on the illusion of openness. Then there's the darker side, the alpha servers and leak channels. Imagine this. You're in a Telegram group with 200 anonymous avatars. No names, no faces, just wallet addresses and whispers. Someone posts a screenshot, a token contract not yet public. Listing on Binance in 36 hours. Within seconds, wallets begin to move. By the time the public announcement drops, the insiders have already doubled their money. Sound far-fetched? It's not. Blockchain intelligence firm Nansen tracked a single leak server that pre-bought 38 tokens before they were listed on major exchanges in 2023. The combined profit? More than $33 million. And the source of those leaks? Usually not hackers. Often it's just underpaid exchange employees, third-party contractors, or marketing agencies with access to embargoed press releases. Information is currency. And in crypto, that's literal. Even the exchanges themselves aren't immune. Insiders at several major platforms have been caught front-running listings, buying coins hours before they go live, knowing the price will surge once the announcement hits social media. Binance has since implemented internal tracking systems to detect these trades, but analysts believe the practice continues across smaller offshore exchanges daily. Now let's talk about market makers. These are the shadow financiers of the crypto world. Their job is to provide liquidity, but with it comes extraordinary influence. A well-placed order book can make or break a coin's momentum. And when multiple market makers work in quiet coordination, they can orchestrate what looks like natural market sentiment. Several on-chain analytics teams have detected synchronized buying patterns across exchanges, linked to a small handful of liquidity providers. They're not manipulating retail traders directly. They're manipulating momentum itself. Once momentum shifts, traders follow it instinctively, and the whales cash out. It's a self-fulfilling prophecy, and it works almost every time. But here's where things get really wild. Some of these secret rings aren't even human anymore. Since 2024, the rise of AI trading agents in DeFi has given birth to bot alliances. Networks of autonomous systems coordinating liquidity moves faster than any human could react. These bots share signals, read smart contract data, and mirror profitable trades across hundreds of chains simultaneously. In essence, it's AI running a cartel without even realizing it. One developer working on-chain under the pseudonym Omen told Decrypt earlier this year, "Humans think they're running DeFi. They're not. They built something that now operates faster and smarter than they ever intended." So who controls the controllers? That's the real question. Because when an algorithm becomes part of a market-making network, it doesn't have ethics, loyalty, or fear. It just optimizes for profit. And that's where danger truly begins. Because the more autonomous these systems become, the less anyone can stop them if they spiral out of control. And that's where the trail gets messy. As soon as you start asking who's actually behind these coordinated moves, you run into shadows. People who exist only through pseudonyms, encrypted messages, and signatures on the blockchain. But they're real. And their influence isn't theoretical. It's measurable. One of the best examples comes from the 2024 bull cycle. An anonymous collective calling itself the Red Chamber was discovered by on-chain researchers at Arkham Intelligence. It wasn't a DAO. It wasn't a Telegram group. It was a mesh of wallets interacting with a dozen projects at once. Each time a new token launched, these addresses seeded liquidity within minutes, then extracted it a few hours later. Perfectly timed with each project's marketing campaign. No single account ever held more than a few $1,000,000, but together they moved over 600 million through multiple ecosystems. A ghost network, hiding in plain sight. When Arkham published their findings, the network vanished within 48 hours. The wallets stopped moving, the addresses went dark. Then, weeks later, some of the same signatures reappeared on a different chain. Same behavior, new name. That's how resilient these groups are. They don't need offices, leadership, or public presence. Just shared intent and code. You might wonder why regulators don't just step in. The answer is simple. They can't. These groups operate across borders, blockchains, and jurisdictions. They're not corporations. They're consensus networks, like crypto itself, just organized around manipulation instead of innovation. Even when law enforcement freezes assets, the capital often reappears somewhere else within days, laundered through mixers, cross-chain bridges, or wrapped assets that blur all traceability. The uncomfortable truth is this: the same decentralization that makes crypto censorship-resistant also makes it corruption-resistant. In the worst possible sense. It's like trying to arrest a cloud, and yet, every now and then, someone slips. In early 2025, a whistleblower from an Asia-based OTC desk leaked screenshots from a private signal group used by major liquidity providers. It showed detailed coordination ahead of token listings, which projects would be market-made, what price floors would be defended, and even when to strategically release negative sentiment to shake weak hands. The screenshots were real. The group went silent the next day, and 2 of its members deleted their company's websites within a week. That's the level of paranoia inside these rings. They know how quickly information travels. They know exposure could mean billions wiped off their holdings overnight. So they live in constant motion, rotating servers, shifting aliases, changing wallet signatures like digital fingerprints. The irony is hard to miss. Crypto was born as an experiment in open access, a world where trust was replaced by transparency. And yet, after 15 years, we've created new elites, just invisible ones. No boardrooms, no handshakes, just whales and algorithms whispering through code. But regulators are catching on. In both the US and Europe, proposals are being floated to classify coordinated trading rings under the same statutes used for market collusion in traditional finance. That means, theoretically, DAOs could one day face antitrust investigations. How do you prosecute an organization without leaders? How do you subpoena a smart contract? Those are questions lawmakers still don't have answers to. Meanwhile, forensic teams are building tools to fight back. Companies like TRM Labs and Chainalysis are training AI to map wallet behavior and identify collective intent, meaning when multiple entities act as one. It's pattern recognition at a scale no human could manage, and they're getting results. One TRM report from July revealed that nearly 22% of on-chain volume in certain low-cap tokens was being driven by tight coordination among fewer than 50 entities. Think about that. Almost a quarter of an entire market controlled by 50 wallets. That's not decentralization. That's oligarchy. But let's be clear. These societies don't control crypto entirely. They just exploit its weakest points, the human ones. Greed, fear, FOMO. The same emotions that built the first speculative bubbles now feed private cabals. And every new generation of traders thinks they're immune, until they find themselves chasing the same insider whispers their predecessors fell for. So what's next? If the last cycle was about retail mania and DeFi experiments, the next one might be about information warfare. We're entering an era where every on-chain move is instantly dissected by AI, where narratives spread faster than regulation can react, and where even legitimate research can be faked by coordinated bot networks. The new secret societies won't just be Telegram rings. They'll be decentralized, automated, and self-learning. Imagine a DAO run entirely by AI models, scraping news, parsing market data, front-running liquidity, and voting on its own upgrades without any human oversight. A ghost cartel that never sleeps, never leaks, and never needs trust. It's closer than you think. Developers are already experimenting with autonomous hedge DAOs that make trading decisions collectively based on reinforcement learning. If that technology falls into the wrong hands, or is trained on data from existing collusion groups, we might be looking at the first machine-run market mafia. That's why transparency will matter more than ever in the next phase. Not because it can stop every manipulation, but because it at least forces accountability back into view. The beauty of blockchain is that even the darkest patterns leave a trace, and somewhere, someone's always watching. So what can the average investor do? First, remember that secrecy feeds on naivety. If someone promises you inside access or private alpha, you're the product, not the partner. Second, keep your assets where they belong, in your control, not on borrowed trust. Hardware wallets exist for a reason, and if you don't hold the keys, you don't hold the coins. If you want to safeguard what you've earned, get your assets off exchanges and into cold storage. We use Ledger, and there's a link in the description if you need one. Crypto will always attract masterminds, manipulators, and visionaries. That's the paradox of freedom. It invites both angels and thieves. But what keeps this ecosystem alive isn't just technology. It's the people who refuse to let the shadows win. The ones who still believe that transparency, not secrecy, is the only path to real trust. So the next time you see a coin spike without news, or a project surge just before a listing, remember this episode. There's a reason markets move like ghosts. There's a reason prices react before headlines drop. Because somewhere, right now, in a private chat you'll never see, someone's already decided what happens next. This has been your daily crypto deep dive. If you made it to the end, hit follow, drop a 5-star rating, and share this episode with someone who thinks markets are random. Because they're not. They're human. They're predictable. And they're run by networks that prefer you never knew they existed. Stay sharp, stay safe, and as always, we'll see you at the top.